Hello and welcome back to Principles of Accounting 1. I am still your host, Dr. B. Very happy to have all of you with us today as we talk about accounting information systems here in the fourth week in the fall 2023 semester. Before we jump into the presentation, I do want to call your attention to where we are in the classroom. So here in the classroom, we are in week 4 already. Yeah, it's amazing how quick time goes by, right? I'm constantly looking at the calendar and saying, man, where does the time go? So here we are. We're in week 4 already, which runs from September 11 to September 17. And this week is what we consider the midterm week for this course, because remember, this is only an 8-week course. So week 4, that's halfway. So you don't have to be a mathematician to figure that part out. But it's important that we understand that, yes, we are in the midterm for this course. And so that's why I wanted to make sure that I drew that to your attention. We're about to cover Chapter 7, which is Accounting Information Systems. There's a lot of work this week, if you haven't noticed that already. And I do notice that a lot of you have decided to work ahead, which is great. I always encourage you to work ahead whenever possible. So for this week, here's what we got going on. Very important. There are two LinkedIn certificates for this week, LinkedIn Learning certificates. One is called Accounting Foundations for Bookkeeping. That has a lot to do with accounting information systems, which is why it's located in this week. And the other LinkedIn certificate is called Excel for Accountants. This Excel certificate is a little bit more advanced than the one that we covered a few weeks ago. And so you have two LinkedIn certificates that are due this week. I know, sorry. I know it's a lot of work, and it really is. The certificate should take you about 3 hours to complete, roughly. So please, I recommend, if you haven't done them already, and I know that some of you have, please do them as quickly as you can, just to get through those, because I know that that's going to require a lot of work of you. Additionally, we have, in addition to those two LinkedIn Learning certificates, we have the Chapter 7 quiz, which is Accounting Information Systems, and then we have the Chapter 8 quiz, which we'll talk about here shortly, and then we have the midterm exam. So that's 5 things that you have to do this week. I know, sorry, I know it's a lot of work. But again, this is a accelerated course. It's only 8 weeks, which is why there's so much content covered in each week. This week's a little bit busier because of the midterm exam. So very important that we cover these 5 things this week. Any questions at all on those 5 things? We will talk about the midterm exam at the end of tonight's lecture. But any questions so far about those 5 things that we have to do? Okay, take your silences. We're good.
Yeah,
But
we're good. We're good, sir.
okay, great. Thank you, Leland. If for whatever reason you have those questions and you think of them later, just feel free to contact me, okay? But we have to get those 5 things done by Sunday night. That includes the midterm exam. So I had sent out a lot of emails, reminders, all of those things last week to tell you that if you're late with things, you have to have those done before the midterm exam. Very critical, right? Because I need to report to the university your midterm score. Yeah. And there's a lot of policies around midterm exams. And one of those is that I'm really not supposed to be accepting late work after the midterm exam. Yeah. So please, again, if in addition to the 5 things we have to do this week, anything that was from like last week you have to complete that as soon as you can, please. Very, very important that you have. That's please just do it. Okay, knock it out. and it's also important to go in order, right? So that's my soapbox. Let's talk about accounting information systems, and then we will indeed jump into the next chapter, and then we'll cover the midterm exam. So this chapter is very short, and it's very informative, but it's very short in nature. And accounting information systems has everything to do with the systems that we use as accountants, okay, that house the information. And you'll hear me refer to accounting softwares like QuickBooks, Sage 50, Oracle, just to name a few. And there's a lot of accounting softwares out there, including Excel, that we as accountants use to store accounting information. And so that's what this chapter talks about in detail. And so I'll provide you with as many examples and stories as I can as we talk about these things. I'm going to talk to you about how these systems work and how the different components communicate with each other through like making journal entries and posting them and using ledger accounts and, and of course we'll do a couple of ratios. Ratios are always fun. So it's important that we talk about the individual components within an accounting information system because in business, this is something you'll likely use. Even if you're going into, let's say, human resources, or maybe you're going to business for yourself, or maybe you're going into human resources, or maybe you're already in something like accounts payable and you're looking to advance, or whatever the case is, or maybe you're in sales, or maybe you're doing something else in operations. At some point, you're interacting with an accounting information system, whether you know it or not. The accounting information system collects and processes data from transactions and events to organize them into reports where decision makers can make decisions based off of those reports. That's the simple textbook definition of an accounting information system. The reason why I said that you might interact with accounting information system at some point, even if you don't know it, is that if you're punching a time clock, meaning you're clocking in and clocking out, that data gets transmitted to the accounting information system. That's how the employer knows how much to pay you. It's based off of the time worked, right? So guess what? You're interacting with the system, accounting information system, through that process. Another thing is, let's say you make purchases or you're making sales for the business. You're a salesperson. Every sale that you make, you have to put into the system. It might look and feel different. You might not think it's an accounting system, but it is. Because the data from those sales entries that you're making for the customer information, what you sold, how much you sold, all that good stuff, that all goes into the system. And the management can pull reports and interpret it and make decisions, right? So that's why I say there's a solid chance that even if you don't know it, you've been interacting with an accounting information system. Okay. There are a lot of internal controls and processes and procedures that govern these systems. Companies establish internal controls to help regulate the flow of information, to protect that information. I'm sure you've seen in the news recently a lot of hacks that have occurred, a lot of attacks on government computer systems, etc. Right? This is unfortunately very common these days. And in order to prevent those types of things from happening, a lot of companies have established what we call internal control processes and procedures that limit access to the accounting information. It's designed to help protect your customers, your employees, and whoever else is involved in your system. And so that is, in a very general sense, an accounting information system. It provides control, relevance, compatibility, flexibility, and of course, it provides a cost benefit. That all of those things make up what we call an accounting information system. They all work in collaboration with each other. This slide, every year they update this particular slide because the world is going in a very paperless direction, and it has been for a long time. And I think that this will probably evolve once again in the future. This is what we call system components. We see the source documents. A source document, as you remember from our earlier conversations back in probably chapters 1 and 2, thereabouts, is something like an invoice, a receipt, a packing slip, a bank statement, a payroll check. These are all what we call source documents. The bank statement. These are all what we call source documents. They provide information about transactions that have happened. We input these source documents into our accounting information system. Now, sometimes this is done by hand, where we will select the drop-down menu, select the debit account, select the credit account, enter the numbers. We just did a journal entry. Okay, so sometimes that can be done by hand, by keyboard. Yeah. But now, because technology has advanced so much, all you need is your smartphone or a scanner. Okay. With your smartphone, you just take a picture of that source document. It scans it in to the accounting information system. It sets your accounts for you. Yeah, it's unbelievable. It uses artificial intelligence to do that. And so it's made the mundane, everyday task of making journal entries a lot easier. By taking a picture of it with your smartphone, it automatically takes the data off of the source document and puts it into your accounting information system. It's incredible. It's wonderful stuff. But it's the world is going increasingly paperless. And so because of that, a lot of the stuff no longer involves a source document. So I wouldn't be surprised in a couple of years we see that part of the slide evolves a little bit more. So we use the input device like a smartphone or a scanner or a keyboard to enter the financial information into the accounting information system. The system processes that information by creating journal entries, ledgers. It adds that information to your process, and then that information is saved in the cloud, right? Cloud storage. And let this be a lesson to you all. I strongly encourage you to use your Microsoft Office 365 account that's provided to you by the university, okay, at no cost to you. There is the cloud storage. It's called OneDrive. You could access it from anywhere. Save everything on that. Do not save anything to your personal computer. Why do I say that, you might ask? Because if something happens to your personal computer, like it decides to no longer turn on, that information's gone. Okay, you're not going to be able to get that out. Not easily, anyway. So that's why having it saved to a cloud storage like OneDrive, or if you have Apple iCloud or whatever clouds, Um, or if you have Google, you have the Google Drive. Save your stuff to those cloud services because something happens to your personal computer or your phone or whatever, it's gone. That information's gone. So, very important to save everything to the cloud storage. Please heed that lesson from me because that happened to me. And I'm telling you right now, losing information is the worst. So, that's why storing it to the cloud is very important. And the great thing with that is with the output devices, you can access the accounting information from anywhere and from any device, especially if it's saved to the cloud. And I personally use QuickBooks for my business, and I use QuickBooks Online. Okay, the cost isn't too much per month, and the reason why I like it so much is everything's saved to the cloud. So it's very secure. It's a great way for me to access my customers' information from anywhere. I could be on the road and access it. I don't even have to pull up a laptop anymore. So, that's just my 2 cents on it. So we take that data and we put it into our accounting information system, and when we do that, we sometimes create what's called special journals by using control accounts and subsidiary ledgers. And so I'm going to show you what this looks like. This is an example of like a QuickBooks or, a much older version, as you can see. This looks like it's on like Windows XP or something. But you can see that there's these little windows that come up, right? And I want you to think of it like a big database piece of software, and that's how I use QuickBooks, right? And so, and just so you know, if you're coming with me to Principles of Accounting 2, you're going to learn how to use QuickBooks. Okay, I'm embedding that into that course, and because I find it very important that even if you're not going to be an accountant, which I'm sure most of you are not thinking about that, but if you are, you'll definitely use it. Or if you're opening your own business, you'll definitely use it. Or if you're going to work for someone else, you're probably going to use it. So that's why I think it'd be great for you to learn how to use QuickBooks or some type of accounting information software. Even like Excel, if you could think of this as being Excel in a bunch of different windows, you'll notice how it's all integrated. You have your sales journals, which is where you record the sales that you made to your customers, especially if you made them on cash or credit or however you made it. We record these here in what's called a sales journal. We also have a journal for tracking cash receipts. So as we're collecting cash from our customers, we're using a cash receipts journal to track that cash that we're collecting. That's how we track our cash balance. Similar with a purchase journal tracks all of the purchases that we've made either on cash or on credit. And so it helps us to track our expenses and our purchase of inventory, right? We use another journal called a cash payments journal, which shows us all the cash going out of the business for whatever, various reasons, paying our bills, paying our employees, paying our vendors, paying our taxes, etc. When we make cash payments, we record that in the cash payments journal. And of course, for special transactions, those one-offs or if we have to make adjusting journal entries, we use what's called a special journals account. All of this to show you that in an accounting information system, we have methods of tracking the subsidiary ledger accounts and the special journals. And so that's what this is designed to show you. So I used the word subsidiary ledger just now, and you're probably wondering, Dr. B, what's a subsidiary ledger? A subsidiary ledger is a list of individual accounts with common characteristics. It details information on specific accounts in the general journal. Here's what I mean by that. Inside of accounts receivable, I have a lot of customers that owe me cash. Okay? Accounts receivable is when a customer owes the business from a sale that was previously made. They received the good or the service, they have not yet paid us. That's accounts receivable, right? And so inside accounts receivable, we have the individual customer accounts. We call these subsidiary accounts. The word subsidiary stems from child. Okay, you have the parent and then you have the child. The child is a subsidiary of the parent. So the way to think about this is accounts receivable is the parent account. The children are the customers, the subsidiary accounts. You see? Each individual customer represents a subsidiary account within accounts receivable. If I add up the totals of all of my subsidiary accounts, I get the total of the parent account, the total accounts receivable. You see? There are a lot of accounts that have these types of subsidiary ledgers. Mostly receivables and payables. Accounts receivable, accounts payable, taxes payable, wages payable. All of these have subsidiary accounts. So in looking at that a little bit closer, and just what I was referring to earlier, here you can see that we have our subsidiary accounts, which are our individual customers. If we add up all of our individual customers together, we get the total accounts receivable, the general ledger. So the way to think about this is, you have your general ledger, accounts receivable in this example. You double click on accounts receivable and it opens up all the detail. Okay? All the detail you see are individual customers and the amounts that they owe. Okay? Those individual customers, the amounts that they owe, that's what we call a subsidiary ledger. You see? So each customer is a subsidiary. Yes, please.
So I was just so it would be like if it was a big corporation and within that one account there's like hundreds and or thousands of customers in each their own particular account and what they owe and how much they're paying and stuff like that.
Exactly. Or even
Like say for example Verizon or something.
a small company. So let's
Okay.
say you run a floral shop. Okay, you sell flowers, and you got like maybe 5 customers that you have accounts with. Those 5 customers, each one of those is a subsidiary ledger within accounts receivable. So it doesn't need to be a big corporation. It could be a local flower shop. If you have more than one customer that owes you, then each one of those customers is a subsidiary ledger within accounts receivable. You see?
Got it.
So, but you're right, Leland. The same concept and principle applies to a larger company as well, like Verizon or whatever. Yeah, you're absolutely right. And that's the way to think about it. Each individual customer represents a subsidiary ledger account. Yeah. And if I add up the total of my 3 customers here, I get my total accounts receivable balance. The same principle applies for your payables. On the right side, we see our accounts payable. I have 3 different vendors that I owe money to. If I add up all 3 of those vendors and their totals together, I get my total accounts payable balance. Accounts payable is the general ledger account. The subsidiary ledgers are my individual vendors that I owe money to. So yeah, that's the concept behind general ledger and subsidiary ledgers. So, how do the transactions work? So I want to show you how transaction postings work from a sales perspective, and I'll show you how we validate all of our ledgers. So here we have the sales journal. Remember, the sales journal itself is representative of the general ledger for sales. So the sales journal shows me the total, and then if I zoom in or I double click, whatever you like, however you want to call it, you can see all the detail. Within that detail, those are your ledger accounts, of course, from accounts receivable, right? So here I have my sales journal. It shows me all of the purchases that my customers made from me, both cash and credit. And I can see who the customer is, the invoice number, whether it's account receivable or cash or whatever. And then I can see the detail for that customer. So if I click on that customer, it opens up their subsidiary ledger account. And I can see exactly what that customer owes me, the history of all their purchases, and their current balance. Yeah, that's exactly what I'm trying to show you here with this slide. Is I can see exactly what happened with my sales, who my customers are, and how much each customer owes me. Okay, so sales is the general ledger account. The sales journal shows me all of my subsidiary accounts, okay, and their respective balances. So $2,150 is my total accounts receivable balance for sales, and that matches up. Accounts receivable and sales match up. It's 2,150. So all of these sales I made here were on accounts receivable, and those customers owe me for their respective balances. Yeah, it's pretty cool. This is the type of thing that you would see within an accounting information system. So how do we validate what the customers owe us? We look at what's called the control accounts. What this does is this shows me the accuracy that the balance that each customer owes me is correct. Yeah. So, for example, Albert Company owes our business $750. Well, how do I know that that's correct? I would open it up and I would look at Albert Company's ledger and verify, okay, here are the two purchases. Yes, they equal 750. And it shows here on my schedule of accounts receivable $750. The schedule of accounts receivable is definitely not a a financial statement. This is the schedule of accounts receivable is an internally used report that management uses to know who owes us what money. Yeah. So if you ever get a job working in accounts receivable, this is something that you would be familiar with. You would see the balances of all of your customers, and you've opened up their ledger accounts, their subsidiary accounts. You can see exactly what the transaction history was for that customer. Yeah. This is the kind of report that you would see only inside of your accounting information system. But this is how we validate the balance to what's happening in their subsidiary ledgers. sometimes, and we talked briefly about this concept, I think maybe 2 chapters ago, returns and allowances. Sometimes, as you know, uh, a, a customer might decide to return something that they purchased. Okay. Oh no, it doesn't work, it doesn't fit, whatever the case is. Okay, no problem. So when that happens, we have to make a special journal entry in our accounting information system. And that special journal entry, it looks like this. We debit an account called sales returns and allowances, and then we credit accounts receivable. In this example, it's $175. So debit 175, credit 175. You'll notice that I credited the accounts receivable to that specific customer that's returning the merchandise. In this example, Ray Bell. So Ray Bell comes and returns whatever they bought from me. I credit their accounts receivable subsidiary account. I don't just credit accounts receivable because I won't know where that was supposed to go. Like what customer was supposed to receive that deduction from their bill, you see? So that's why it's important that we identify the subsidiary account in these types of transactions. So what happens with cash? We talked about accounts receivable. What about cash? So cash has its own receipts journal, as we talked about. And every time we receive cash from our customers for their whether it's from sales or whether it's from customers coming in and paying their accounts receivable, we need to make sure that we allocate that cash to wherever it's supposed to go. In this example, I got a couple of customers that are paying off their accounts receivable, and I also made some sales using cash. So looking at the accounts receipts journal at the top, you can see all the sales that I made using cash. And you can also see customers that have come in and paid down their accounts receivable. And so I make the transactions to match where that cash is coming from. So if it's cash from sales, I debit cash and credit sales in the journal entry. If it's cash coming in from an account receivable, I debit cash and credit account receivable, and then whatever customer is paying us. Okay. When I do that, it updates the subsidiary ledgers. It also updates the cash receipts journal. So this is what it would look like in an accounting information system, just a very general sense. Now, how do you then validate that the cash balances are correct? You might ask. So every time I'm collecting cash from my customers, and I'm collecting cash from whether it's their receivables or they're paying cash over the counter for the purchase or whatever, it's updating the total cash balance on the balance sheet. Every time I use cash to pay for things, it's updating the cash balance. So regardless of what you're doing, whether you're making purchases for the business or whether you're paying bills for the business or whether you're collecting cash from your customers, the balance on the balance sheet for cash is constantly updating based off of these transactions. So how do we validate it? We do what's called a balancing, right? Right. This is kind of like a pre-trial balance in a way. So the way it works is we have a debit column which includes cash, sales discounts, cost of goods sold. And that gives me my total debit, my total debit cash amount, basically, right? Total debit for sales. Cash minus discounts minus cost of goods sold gives me my sales balance, $32,350. I compare that to my accounts receivable plus sales plus other accounts plus inventory. And what this does is it validates that the cash that I have received balances with the cash that it balances with the sales, accounts receivable, and the other accounts. You see, it's just a way of checks and balances. This is the best way to think about it. So what about purchases? When I use cash to make purchases or I use accounts payable to make purchases, it works the same way. There's a purchase journal, purchases journal. Within that journal, I have my subsidiary ledgers. The subsidiary ledgers represent the balances that I owe each of my vendors, and that ties back to the purchases journal and to the general ledger, and then all of my various expense accounts and my total accounts payable. So I can see here, for example, I have 5 vendors that I owe money to. If I add them all up together, that's $1,325 that I owe total for accounts payable. I trace that back to my accounts payable ledger, general ledger. And then that accounts payable, I can also track what those purchases were for. I bought inventory, office supplies, and store supplies using accounts payable. You see? It shows you how it's all connected. Now, how do I verify that all of this is correct? We prove the ledger by adding up all of our individual vendor balances to equal the total accounts payable. If it doesn't balance, then we know we made a mistake somewhere. Like, for example, one time this happened to me. One time I paid a bill that the company received, but I forgot to check mark the invoice, the bill in my accounting information system. If I don't check that off when I'm paying that bill, it marks it as unpaid. Right? So it's like, well, I paid it. So I looked at my accounts payable balance and I was like, wait a second, this doesn't match what I have in my bank statement. So what's the problem? So I had to go back through and figure out, oh, I forgot to mark that as being paid. Well, I paid it. I just didn't mark it in the system as being paid. So these are the kinds of things that, if when you're working with accounts receivable and payable in your accounting information system, you have to be very careful with. Because if you forget to mark it as being paid, or your customer pays you and you forgot to mark it off their accounts receivable, it could cause some balance problems. And then you have to go do some forensic accounting to figure out what happened and then fix it. So, just something to be aware of when you're working in an accounting information system. With cash payments, works very similar. We have the cash payments journal, all of the cash payments I make for the business for various reasons. I paid cash for things like inventory. I paid down my accounts payable. I paid salaries, expenses. All of these things are general ledger accounts. Within accounts payable, of course, there are my subsidiary accounts, my vendors. All my individual vendors are there. And it shows all the payments I've made to all of my vendors and all of my other things using cash. And sometimes we have to make those special journal entries for various things. And one of those we talked about already, which is the sales returns and allowances. But other reasons why we might have to make adjusting or special journal entries is for things like the purchase of property, plant, and equipment using notes payable. Just like we talked about before, notes payable is when we took out a bank loan. That's what it means. It's a bank loan, okay? We used a bank loan to purchase property, plant, and equipment. That requires a special journal entry. We received cash from a bank loan. That requires a special journal entry. We have purchased returns and allowances, meaning we bought some stuff from our vendors and returned some stuff. That's purchase returns and allowances. Special journal entry for that. And then, of course, we have adjusting entries and closing entries. Remember the accounting cycle. At the end of the accounting cycle, we have to close all of our temporary accounts we close all of our temporary accounts through that closing process, right? And so that requires special journal entries. But those are the kinds of things that we would do in an accounting information system for special journal entries. I had mentioned these names already. Accounting information systems, there's a lot of them out there. I personally use QuickBooks. About 80% of small businesses in the United States use QuickBooks. Sage 50 is another one. Larger companies might use something like Oracle, which is more of an enterprise resource planning system. They all do basically the same type of thing. They help to track all of the accounting information components, which also includes human resources. And it also includes tracking your customers, your vendors, your sales data. Pretty much everything you want to know about your company is housed in this information system. Yeah. It's very much integrated with a lot of other software components. For example, I can take credit cards, right? I can swipe those using my Square. It's called Square. Like if I go to like a trade show or to like a place where a lot of vendors are, like in a fair or like a street sale or whatever. A lot of vendors, they use what's called Square or some type of way to swipe credit cards. Yeah. So they scan it right there. A lot of these softwares are integrated. So as soon as I swipe that card, it automatically posts to my QuickBooks. What the sale was, how much it was for, how it was paid, all of those things. There's a lot of integrations. But that's, very general sense. And of course, you could use Excel. Some businesses use Excel, and there's nothing wrong with using Excel. The only problem that might come down the road is when the business grows a lot, Excel's not going to cut it. Okay, it's just, it gets to be way too much work after a while with Excel. So that's why I always encourage business owners to move away from Excel and get into something like QuickBooks or there's so many of them out there. There's one called Mint. There's FreshBooks. There's a whole bunch of them out there these days. But I encourage you to explore. Take a look. You can do a free trial using QuickBooks. If you're going to take Principles of Accounting 2 with me in the future, there's a great chance you'll be using QuickBooks there. But I encourage you to explore. Have fun with it. Take get some ideas. So let's talk about data processing. Data processing now is heavily automated. It's very heavily automated. You use artificial intelligence for the data processing. It used to be very manual. We used to have to do like keystrokes and manually enter information. But now with the advent of online processing, it's instantaneous. So when I swipe a customer's credit card, it automatically goes to my bank account. I don't have to wait. Especially for the sales done over the internet. At the end of the day, I have to batch out the credit card process, though. Here's what I mean by this: batching out. If you've ever worked in retail, you know what this is. So at the end of each night, you're supposed to. Some places don't. I don't know why they don't, but some places don't. At the end of each night, you close out your credit card machine. Okay? We do what's called batch processing. And what it does is it posts all of the transactions you made using that credit card machine. It posts it to your bank. Okay? That's called batching. You're taking a whole lot of transactions at once. You're batching it. Okay? That's why sometimes, and I've had students ask me this question, well, Dr. B, once in a while, I'll see something on my bank app on my phone, and it'll say pending. Why does it say that? The transaction was like 2 days ago. I went to the gas station 2 days ago. It still says pending. Or I went to that restaurant 2 days ago. It still says pending. Dr. B, why does it do that? That's because the place that you went to didn't close their batch out yet. When they batch out the credit card transactions, that's when it posts to your account. You see? So now you know. You know why it says pending. It's waiting on the place that you made the purchase at to close the batch. Yeah. Sometimes they take a few days. I never know why this slide is here because it's different these days. A computer network. Hopefully, I don't have to explain this to you all, but I will. A computer network is where a bunch of computers are linked together using a server or database. Okay, a lot of companies have this. For example, at UDC, there's a lot of computers on the network, and they're all over the area, right? A lot of different buildings. Some professors take their laptops home with them, like me. Some students have UDC laptops. They take them home with them, but they're all on UDC's network. Okay, they all have access to the same databases, like your UDC accounts and all that. It's all on the network. See, that's what that means. Same thing in accounting. It works the same way in accounting. I mentioned this one earlier, enterprise resource planning software, ERP, Oracle or SAP. Those are the two biggest ones on the market. And what they do is they help to manage not just the accounting part of the business, but they also manage things like inventory. They control assets like computers. They take care of all the depreciation for property, plant, and equipment. The list goes on and on. The ERP systems are huge, but it's basically one program that's integrated with all of the business's operations. Yeah. This is most useful. Accounting has become a lot more visualized. Well, what I mean by that is we've moved from just looking at spreadsheets and reports. Now we can see things in a more visualized way through graphics, interactive dashboards. Um, data is a lot more visualized now. It is more interactive, and accounting is leading the way when it comes to interactive data. There are softwares out there like Tableau and Power BI. I personally like Power BI. It's a really cool software. You already have access to it as a UDC student through your Microsoft Office 365 account. It is a great way to create dashboards of information. It's a really cool way to track progress on projects and make financial projections, and it helps management to make decisions. It gives them insight into the information in a visual way. That's what data visualization is. And that's what data analytics is. It analyzes the data to help individuals make decisions. Yeah, best way I can describe it. But it's very modern stuff. And of course, one of the last things is cloud computing. You've already been doing cloud computing, even if you don't think you have. You have. If you're online right now on WebEx with me, guess what? That's cloud computing. Okay, some of you are on here on your cell phone. That's cloud computing. Some of you accessed My UDC through your cell phone or tablet. That's cloud computing. Okay. It's the use of applications over the internet virtually. Yeah, that's cloud computing. I always said that I love ratios. I don't know why I do. They're just interesting to me. This one's cool. Okay, this one's called the days payable outstanding. It tells me how long, basically. How can I describe this? It tells me how long payables are deferred until the payment is made. What I mean by that is, how long has it taken me to pay my bills? In terms of number of days, on average. How long does it take me to pay my bills? This is useful because I can get a gauge of how well a company is performing based off of how quickly they're paying their bills. So we take total accounts payable divided by the cost of goods sold, and we multiply that by 365 days. Here we have an example for Costco and Walmart. So accounts payable 11,679 divided by cost of goods sold 132,886. This is in millions, of course, so add a couple more zeros at the end. For Costco, 32.1 days. For Walmart, they're at 44.6 in comparison. So Costco doing pretty well. Walmart, they're slow to pay, but that's because of the agreements they have with their vendors. It's just fun. It's a fun calculation to make, especially if you're looking to invest. Okay, that is the end of our discussion on accounting information systems. Any questions on accounting information systems? Anything we didn't cover that you hope we would? Okay? Are we okay? Accounting information
No, we're
systems?
good, sir.
All right, great. I told you it was a straightforward chapter, and it really was, and it was very quick, and it really was. Okay, so I'm going to stop this part of the recording, and then we'll start the next chapter. So please stand by and hang on tight.